So this is Money Mind channel. On this channel, we'll talk about money investing, money saving tips, and so on. So the goal on this channel is to make sure that we all, going to achieve that financial freedom. Right? Depends on how you interpret your financial freedom, but that's the main goal, and that's what we talk about money. So now, this is a question I always hear a lot of people ask, and some of my friends ask this question a lot of time, and I say, I'll make a video on this, right? And the question is, um, investing in real estate or versus stock, which one is better investment? So if someone has a $20,000, say cash, I had a friend of mine who said, well, I have a $20,000. Do you think I should put my money in a stock, or should I just buy a house and rent? Make a rental property. What do you think? And I say, what? There's a pro and cons on both sides. And in order for me to explain to him, and I said, I'll make a graph, I'll make a video on this, right? And that's exactly what I made this video. So, and the topic today, as I said, will be real estate versus stock. Which one is best investment for your money, right? So here I say this is my blog, which is called moneymind.ca. So there are always this question from a friend, and people I know always ask these questions, real estate versus stock, where should I put my money? So here are the pros and cons, right? Real estate. So we'll start with this. This is number one. So we'll be real estate versus stock, right? So pro on real estate will be cons on in the stock market. So the first one is ability to leverage. When you buy real estate, you can have $20,000, for example, right? And then you want to buy a house of $400,000. You will be able to do that, because 20,000 of $400,000, that's 5%. In most places where you're first time home buyer, you can actually put just 5% and you get a house. That's a $400,000. That's like a huge leverage, right? Not only that, when you have a house and your house appreciates a little bit, you can also borrow the money, what we call the homeowner a line of credit. You can also get the money and you use the money, maybe even buy another houses. So that's one of the things you can do. So we say is ability to leverage big on real estate. On the stock market, on the other hand, right, no leverage to invest in stock market. So if you have a $20,000 invest in stock market, you can only invest that $20,000 to buy the S&P 500 or to buy Apple stock or something like that. There is a way to leverage in the stock market, but it's very kind of complicated way, and it's not the same as a stock as a real estate. You can only leverage what we call a margin, which is very finicky way. You don't want to do that. I have experience on that. Number two is a passive income. So when you have a real estate rental property, right away when you buy houses, you sign everything, it's done. You can have a renters that will pay you monthly, and you can use this monthly income to pay your mortgages, pay insurances, pay all that stuff, right? On the stock market, on the other hand, there is a passive income, but that's just in forms of dividends, right? Which is it depends on how much. If it's 5% annually, that's all you get, right? Tax advantage. There's more tax advantage in real estate. For example, when you have a house and you buy a house and then you live in that house for about 5 years, I believe, and you sell the house and your house appreciate whatever percentage of appreciation, as long as your house was a primary residence, you don't pay tax on the capital gain. On a stock market, on the other hand, when you sell your stock, you can trigger huge tax. So it depends on what kind of account that the stock is being invested. Number four, it's real estate is always a hedge against inflation, because the market usually goes based on inflation, so which is about 2.5% in North America, and very rarely that house would go lower than that. Not necessarily it's gonna go higher, but it doesn't usually go lower than inflation. So it usually fluctuates with inflation. if the market is stagnant, it doesn't grow bigger. Well, some stock move sideways for years. For example, there's a stock here in Canada, for example, Bombardier has been, within $2 range for long period of time. No, too volatile. So when you invest in the stock market, you will see the move every day. You see the daily move. It can jump for 10%. It can go down 20% in one day, but that's not the same in a house. It's not too fragile, or not too volatile. But it always goes very smoothly. The graph, it goes up and down, but very slowly. And then the other thing, which is number 6, no fluctuation, emotional. So because the real estate, you can see the house is more tangible thing, is more visual. You can see the house. So there's no much emotional attached to the house versus in real estate. Versus in the stock market, because you can see the graph. You can log in your account and you can see your stock. For example, let's say Tesla is going, bad reporting. Maybe the earning on that day is not good, and you can just tank 10%, and next day can go 5%. The following day can drop 7%. So there's an emotional attached to investing in stock market, unless you're a very, very experienced investor, and maybe you one of those people that you've put in index or type of mutual fund that you don't even log daily in your account to check how the stock is doing. So that's number 1 of the graph. I make a two chart here. So the chart number 2 is going to be con, and this is a pros on the stock market. So there's more work when you buy real estate. There's more work to do. You have to search the place. You gotta do this, and if there is something broken in your house, you gotta fix it. Or if you don't fix yourself, you have to call other people to fix your places. But in the stock market, when you buy Apple stock, you don't have to do anything. There's no work involved. You just do your research, which is gonna take about 10 to 20 minutes. Once you've done that, you execute the order, and that's been done within 2 minutes, and that's it. You can hold the Apple stock for 20 years. You don't do anything, and you just get dividends, right? Expensive and illiquid. So when you buy a house, first of all, it's a very expensive property, right? You can just buy a house for $10,000. Versus a stock market, you can only afford, like, if you can buy a stock for $500. Not many people can afford to buy a house for $400,000, which has mortgage and other stuff, and not many people can have down deposit. Let's say, for example, the requirement, for example, right now in Canada is required. Most places you have to pay 20%. So if your house is $400,000, that means you have to come up with 80 grand. $80,000. That's a lot of money. Most people cannot afford. Where versus a stock, you can say today you have $100, you can actually buy. Let's say you can buy a couple stock or 10 stocks. Depends on which stock you're buying, which company you're buying. And when we say illiquid, it's very liquid. So let's say, for example, you have $100 or $10,000 invested in Amazon or any other stock. You can just go on your brokerage right now and execute and place the order to sell that stock, and right away you have the money in your account, and you can transfer the money. You can withdraw within a couple of days, within a day. You have your money, right? Depends on which company you invest your money with. Versus real estate, sometimes you can take up to a year or 6 months or 3 months. Just it depends on the market and the area to sell your house. The other thing is number 4 is not always appreciating value. That is that most people believe that when you have a house, house always appreciate, house always appreciate. But I do know a lot of people, a lot of friends that have houses, and they do not go up. The market is flat, or in some cases it can actually even go down. right? We've seen this in 2008 in North America, like in the US and in Canada. We've seen the houses that went down 20, 10% down, right? But we can say the same thing when it comes to stock. We can say the same thing, but you can a little bit mitigate in the risk of a stock market, because you can always, let's say for example, if you invest in a stock market, S&P 500, right? It can go down, but it's always come up, you know. But this I can say they're pretty much the same in terms of value. I mean, the appreciation. House can go up, and stocks also can go up or down. Less diversification. So when you invest in real estate, you have that one property in one place. That's it. You don't diversify. When we come to stock market, when you invest in S&P 500, you've invested in 500 American companies, the biggest companies. That's Amazon, that's different businesses than Apple, that's Home Depot, that's different things. So you diversify your money in the stock market versus houses. You just have one type of investment, which is real estate, right? And there's not transferable. So when you invest your money in this real estate, so you have a house, that's more of a personal thing. It's a personal or company or corporation, whatever you put under your name. But let's say, for example, you cannot take that investment and put it in your retirement account. If it's a stock, you can always say, well, you know what? Hey, I have a $20,000. You can put in Roth IRA or tax-free accounts where all your income and all your gain is tax-free. Or you can put in a retirement account where you can go tax deferred. So you don't have to pay tax at this time. So those are the thing. Those are the cons and pros and real estate versus a stock market. So here's the thing: if, let's say for example, you're one of those people who say, well, you know what, you don't want a stock market. I mean, you kind of like REIT, but you don't want the hassle of buying the investment of like going look for properties, dealing with the maintenance, dealing with the tenants, and all those stuff. There's another way to do it, is to buy REIT. So what's a REIT? REIT is real estate investment trust. So REIT are the company that invest in these are the company that own income producing real estate, like apartment buildings, warehouses, office buildings, malls, and hotels. And these companies, they usually pay 90%. Actually, by law, they're required to pay 90% of their income to shareholders. And that's how you make income. And you just buy the REIT just like a stock. You just go on your brokerage account, you buy REIT for whatever amount you have, and you own real estate. It's not tangible, but it is real. You can see, for example, here in Canada, we have, for example, Ryokan. He owns a lot of malls. When you drive around, you will see the signs outside. They say Ryokan. And you can go in that mall, you can shop. Then you own that property, portion of it. That's another way to invest in real estate. So that's my take. So if you have any question, leave your comment below. And if it's your first time on this channel, please like it and subscribe and hit the bell button so you can get more notification on any new videos I'm releasing on investing and savings. Thank you very much for watching this. And this is Beautiful House. Thank you very much. Bye.